Hi, and welcome to Chapter 3. In this chapter, we'll be talking about financial statements, cash flow, and taxes. This chapter will be broken up into Part 1 and Part 2. This is Part 1. Now, the overview of Part 1, we're first going to look at the key financial statements: balance sheet, income statement, statement of stockholders' equity, and statement of cash flow. Then we will look at the free cash flow, economic value added, and modified value added. And then we'll look at the federal tax system. So let's first start with the four financial statements that make up the bulk of the annual report. So the annual report is something that public companies will produce to pass out to shareholders, and it's a very important document because it's going to contain two types of information. First is going to be a letter from management to discuss the overall operating results of the past year, discuss new developments, future operations, so an overall management review and moving forward perspective on the company. Then the second part will look at four financial statements, and the balance sheet, which is going to show the amount of assets the company owns in comparison to the liabilities and equity. The income statement, which is sort of like a paycheck, which is going to look at all of the sales for the company minus all of the costs to come up with a net profit. And then the statement of cash flows. And the statement of cash flows is going to look at how the cash is coming into the company and out of the company. Is it increasing or decreasing? What are the sources of the cash? And finally, the statement of stockholders' equity, sometimes known as shareholders' equity. And this shows the amount of equity that the stockholders of the company have at the beginning of the year and then have at the end of the year. Hopefully the equity has increased because that means their percentage of ownership of the company or the part of the company that they own outright after the liabilities are paid has been increased. Now, we'll move to the next slide. We're going to take an example of this company, and we can look at this is a snack food company that underwent a major expansion in 2017. So the expansion has been not the greatest. The company has a weak cash position, suppliers are getting paid later and later, and the bank has threatened to cut off credit. So the board of directors has ordered that some changes need to be made to this company. So let's look at. So let's review the balance sheet here. So if we see 2017 versus 2018, we see that cash has decreased by about $50,000. Accounts receivable has increased, and this is money owed to us but hasn't been paid yet. So a poor job of collecting the accounts receivable. Inventories have increased greatly, and then that's a big drawdown on cash as you're buying new inventory. So the total current assets have went from 1.1 million to 1.9 million. So the gross fixed assets also increased from about 500,000 to 1.2 million. And you take away depreciation, we have our net fixed assets. Depreciation is sort of like the reduction in the value of these assets. Like your car depreciates year over year as you drive it more and it gets older. So the total assets have increased from 1.4 million to 2.8 million. But they increased in a way that's not necessarily healthy for the company. Cash has been decreased, accounts receivable and inventories have been increased. So that's, even though it's a pickup on assets, it's not generally the way you want the company to go, because you want the cash to increase and hopefully your AR remains stable or decreases and your inventory remains stable or decreases. If we look at the second section, liabilities and equity, we see that the accounts payable liabilities have increased. That's not good. Accruals have increased. This is money that is owed, like you can accrue payroll. So it's things that we owe, but as a company, we haven't paid yet. Notes payable has increased. So the total current liabilities have increased greatly. Long-term debt has increased. Common stock, it remains the same. Retained earnings have greatly decreased. This is the amount of money the company makes but keeps in the company. And total equity has about almost $200,000 of total equity has been destroyed. So the total liabilities and equity has increased from 1.4 to 2.8. And you see how this the assets 2.866 match the liabilities and equity. That's why I call it a balance sheet. So overall, not a good development in the balance sheet. Let's look at the income statement for this company. So here, sales increased. Well, that makes sense. They purchased another company. So sales increased. Cost of goods sold increased. Other expenses increased. If we look at operating costs, total operating costs and depreciation and amortization. So operating costs look like went from 3 to 6 million, and our depreciation went from 18,000 to 116,000. So we had a EBIT is earnings before interest and tax. So that's our operating earnings, and we had positive operating earnings in 2017, but a negative operating earnings in 2018. So that's bad. Take away our interest expense, which increased greatly for the debt we took on. Earnings before taxes, we went from a profit to a bigger loss. We look at our taxes. After we pay our taxes in 2017, our profit is only 87,000. Here we get a tax credit for the loss, so our net income is a negative 160,000. So not a very good year for this company. So if you look at the number of shares, they remain the same. Earnings per share went from 88 cents to a negative 160. Dividends per share went from 0.22 to 0.11. Stock price went from $8 to $2, and lease payments stayed the same. So again, some big changes at the company. If we look at the statement of shareholders' equity, we see that at the end of 2017, they had 100,000 shares worth $460,000 based on the par value. Retained earnings was 203,000, so the stockholders' equity was 663,000. So in 2018, our retained earnings, net income was a loss. Our cash dividend was paid, so that resulted in a subtraction in our total retained earnings, which brings our equity down to 492. So that's destroying equity, not something investors like. If we look at the cash flow statement, we see that our net income was a drawdown on cash. Our depreciation was a pickup as we add that back because it's a non-cash charge. Increase in accounts payables and accrual was a pickup in cash. Not one we particularly like because these have to be paid back. A decrease in accounts receivable. Increase in accounts receivable is a decrease in cash because we sold things and weren't paid for them. An increase in inventory is a decrease in cash as we spend more on inventory and it draws down our cash. So our net cash provided by operations is a negative 164. So we have a reduction in our cash flow, and that is also bad for a company. So if we look at where this cash flow change, where the activity comes from, we have two areas. We can look at investing activity. So this is additional plant and equipment that was purchased. So the net cash used to buy these investment activities were $711,000. If we look at the financing, we see that we brought in money through notes payable, long-term debt. We did pay a dividend, so total financing provided was $125,000. So now that's not the best way for cash to increase because we want cash to increase from operations, not from. So here's our operations. This is part one of our cash flow. Cash decreased from operations. So if we take the 164 and we add it to the negative 164, we add it to the negative 711 plus the positive 825, we have a decrease in cash of 50,000. So our cash at the beginning of the year was 57. Now we ended up at 7. So that's where that came from on the balance sheet. So this is not the right way. The best cash flow is cash flow from operating activities running the company, and that's negative. In investing opportunities, that's usually negative as we invest more in the company, but the financing activities mean that we had to finance our investments rather than use our retained earnings. So cash flow is rather weak. Okay, so let's look at the conclusion here. Okay, so financial conditions from the statement of cash flows. Net cash flow from operations is negative, and that's because they have negative net income. Borrowing is a positive cash flow and to meet its cash requirements, but borrowing comes with additional debt that has to be paid. So even after borrowing, the cash flow fell by 50,000. So this puts this company in a very weak position. Now, if we look at net working capital, net operating working capital, and net operating working capital, it can be computed in two different ways. So let's look at net working capital as simply current assets minus current liabilities. So it's the current assets like cash minus current liabilities like notes payable gives us our working capital. And we like to see a positive number here where the current assets are bigger than the current liabilities. Now the net operating working capital, we look at the operating current assets minus the operating current liabilities. So to break that up a little bit, what are the operating current assets? That would be the current assets minus the excess cash, and the operating current liabilities would be the current liabilities minus notes payable. And this just gives us an operating working capital as opposed to just a regular working capital. So if we want to look at this particular company, we want to, did the expansion create additional after-tax operating income? So if we want the after-tax, AT is after-tax operating income, we take the EBIT, multiply by 1 minus the tax rate. So their EBIT at, say, negative 130 times 1.4, 1 minus the tax rate is 0.6. That means that our after-tax operating income is $78,000. So, and that's in 2018. In 2017, it was $114,000. So the after-tax operating income went down, which isn't good. So let's look at our net operating working capital. So if we take our current assets minus excess cash, we subtract that from our current liabilities minus notes payable, we find that our net operating working capital is $905 versus $784 in 2017. So let's look at the assessment of the expansion on the operations of the company. So here we have sales of $6 million versus $3 million. Our after-tax operating income has decreased. Our net operating working capital has increased, but our net income has decreased. So the expansion is sort of a failure at this point. It has not really generated much of what we wanted it to generate for us. So this is why, after a big expense is made, like an acquisition or purchase of a company, we want to look at the financial statements and see, how did this turn out? How did this work out for us? And we could see from these slides that it was not really the best. Now, let's kind of review the balance sheet really quickly. So I'm just going to move this picture over here and show you that, our total current assets should match our total current liabilities, and it has to match for the balance sheet to be correct. So on the asset side, we want to see that, how are the assets being increased? So if we're increasing cash and accounts receivable and inventory, or long-term plant and equipment we want to see that being financed through equity rather than liabilities. So if the company is currently increasing current liabilities and long-term debt to pay for the new assets, that makes the company riskier because that has to be paid back with debt. But if the company is using retained earnings, the money that the company makes from operating the business to pay for new assets and short-term and long-term assets, that's a better, stronger balance sheet that we would have. Then that also helps to increase our equity, as we're using equity to pay for more balance sheet and shrinks our liabilities. So that's what we want to see in a stronger balance sheet. Okay, so this is why it's important for financial people to be able to look at these sources of funds and analyze depreciation and look at how the company is changing things around to get a better understanding of how their balance sheet is being affected by changes in the business. Okay, so now we're going to look at the free cash flow. So we're going to talk about and look at this free cash flow and try to decide why we should comprehend this, why this matters to us. So we have the first formula here, and it's free cash flow equals, remember, EBIT is earnings before interest and tax. So this is really the pure earnings of the company before we pay any interest or tax on the operations. So if we take the EBIT and we multiply it by 1 minus the tax rate, we'll get our earnings after tax. And then if we add back depreciation and amortization, these are non-cash charges. So we deducted them from income to reduce the taxes, but we're adding them back now to increase our cash flow. And of course, we subtract any capital expenditures, investing in the company, and add back any net operating working change. So what we see as far as the free cash flow for 2018, we have our EBIT here minus the tax rate plus our depreciation minus the capital expenditure. Okay, so minus the net operating working capital, and well, because it's negative, and then we what we're gonna get as a result is the 794. So again, EBIT times 1 minus the tax rate plus amortization minus we look at the capital expenditures. This is the difference in the capital expenditures year over year. So we take 2018 minus 2017 to get our total net capital expenditures increase or decrease, and we add the net operating working capital, and that gives us the 794. So is negative free cash flow always a bad sign? Not always, but it's generally more of a bad sign than a good sign. So, I mean, what we've talked about so far previously to the free cash flow has been, the financial statements. And those are prepared, of course, by accountants. And the accounting statements are designed in a way that a multitude of different people can use them, such as creditors, tax collectors, managers, stock analysts. So the corporate decision makers and the securities analysts usually modify the accounting data to meet their needs of how they want to look at the company. So the free cash flow is one way that we could use the inputs from the financial statements to give a better idea of what the company is doing. So the equation here is really going to show us the amount of cash that could be withdrawn without harming the firm's ability to operate and produce future cash flows. So now when we do have this EBIT times 1 minus the tax rate, this is sometimes referred to as NOPAT, net operating profits after taxes. Depreciation and amortization are added back because, like I said before, these are non-cash charges, which means that we reduce the income by this, but when we're calculating our taxes, we add it back after taxes because really this cash didn't leave the company. Now, so when we're looking at this, capital expenditures are sort of the increase in fixed assets that we're buying. So we want to know the amount of cash the company used to invest in these fixed assets, plant, equipment, machinery. So the company that's invested in these fixed assets, that's going to affect the cash flow because we're taking cash to buy this equipment. So if we don't generate enough cash to pay for these current investments, we could end up with a negative free cash flow, which means that we're going to have to borrow money to fill the hole that negative cash flow has generated. So that's not necessarily a great thing. So some companies can run a negative cash flow. If they make a big investment that's going to pay off longer down the road, then it's not necessarily that negative of a thing to happen. So we're not, we say most of the time it's not good, and it's attributable mostly to this increase in capital expenditures and of course some of the net loss. But as long as this company is able to meet production and keep going and has money to borrow to fill this negative cash flow, it's not as bad as it might seem. Okay, so moving on. So let's look at performance measures for evaluating managers. So managers run the company, and we want to know, how they're doing. So let's look at MVA and EVA. So these are because accounting statements aren't going to be 100% sufficient for telling us the full story about managers' performance. So that's why we like to look at some other ways of measuring performance. So now the financial statements, of course, are a historical look at the past values, the current market values, and there's a lot of differences that can occur that are not always easily pinpointed to how the management's doing. So changes in interest rate and inflation can affect the market value of the company's assets and liabilities, but that's not the manager's fault. And a lot of times they have no effect on the corresponding book values shown in the financial statements. So the market's assessment of the value has to take into account the ongoing assessment of the current operations as well as the future operations that the management controls. So if we look at a company like Microsoft, it costs very little to develop its first operating system, which they purchased and modified. And that system turned out to be worth many billions of dollars in the future. So in the beginning, when they purchased it, they probably didn't have the best financial statements, but many years after that, it contributed significantly to ever increasing and stronger financial statements. So, increasing the asset value can lead to an increase in the market value of the equity of a company as long as the managers make good use of those assets that they're purchasing. And what we want to do is, since the accounting statements do not reflect the market values, and when we say market values, we're bringing in the stock value. They are, so not sufficient for the purposes of evaluating the manager's performance, because we want to really look at the stock price in relationship to the performance. So MVA, market value added, is simply the difference between the market value of the firm's equity and the book value shown on the balance sheet. So the market value is found by simply multiplying the stock price by the number of shares outstanding. So say, for example, you could have a stock price of $25 and 1,000 shares. So $25 times 1,000 shares gives it a market value of $25,000. Now, if we subtract the book value, and the book value is basically the assets of the company minus the liabilities of the company, or the book value, also known as equity. So if we subtract the current equity, we can see how much market value was created. So sometimes market value, if the company is exciting to investors and the company is doing well and the stock price is going up, you'll see that the market value is being added. So that means investors like what the management's doing, and you could see that in the change in the MVA. So that's a very important thing to look at, how using the stock market to judge the performance of the company. Now, we could also look at the EVA. So the EVA, if we're going to look at, is economic value added. So the economic value added is going to be, it's related to the MVA. So the benefits, look at the benefits of the investments, and hopefully they exceed the cost of raising the money for the capital. So the EVA is pretty simply, okay, we've borrowed a bunch of money to invest in the company. Let's hope the returns of the company are greater than the interest the company has to pay on the money that they raised. So the total invested capital represents the amount of money the company has raised from debt, equity, and any other source of capital, such as preferred stock. The annual dollars used to finance the cost of capital is the total invested capital multiplied by the after-tax percentage, or what we call the cost of capital, which we're going to learn about more in a future chapter. So, for example, if a company raises $1 million in capital and the current cost of capital is 10%, then we know that the cost of this capital is $100,000. Basically, the interest we're paying plus, to get this capital, $100,000. So the funds raised by this $100,000, by the $1 million, should be invested in a variety of projects and assets and operating in the operations of the business. So in any given year, we look at the NOPAT, which is the amount of money that these investors have generated for the company investors after paying for the operations cost and taxes in representing the benefits of the capital investment. So the EVA is the estimate of the business's true economic profit for a given year, and it's often it can be very different than the accounting net income. So that's why the EVA is a better measurement of what value the manager's created than the net profit, which can be certain things can change the net profit more drastically to make it really unrepresentative of what the company's truly economic power has been developed by the company. Because EVA takes into account the total dollar cost of all the capital, including the cost of debt and cost of equity capital. So if the EVA is a positive number, the after-tax operating income exceeds the cost of capital. And that means that we're making more money than the money that we're paying for the money we borrowed, which is how you know a business is doing well. So on an annual basis, the EVA helps ensure that the MVA is also positive. So whereas the MVA applies to the entire firm, EVA can be determined for divisions as well as companies as a whole. So we could use it at many different levels to kind of look at how a company is doing. Okay, so here are we can look at two examples for MVA. We could look at the stock price times the amount of outstanding shares minus the, what did I say? Minus the book value, of course. So here there's a negative and market value added. Because the stock price went down so much, of course it destroyed market value. So that's bad for management. But if we look at the MVA for 2017, they actually created some market value. So this is a really bad performance. Shareholders' wealth has been destroyed, and that's why the stock price is going down and why shareholders are not super happy with. So what is the relationship between EVA and MVA? It's sort of like what I talked about before. So if EVA is positive, then the after-tax operating income is greater than the cost of capital needed to produce that income. So that's a good thing. And if EVA is positive on an annual basis, it helps ensure that the MVA is positive. Because if the company is creating economic value added, then most likely they've created market value added. So the market value added is applicable to the entire firm, where EVA, of course, what I talked about before, we can break it out by divisions or sub-product lines, or so it can be really worked at many different levels because of the inputs that we need can be broken down to smaller areas. So this is really a good way to judge the progress that the manager is making with a company. Now, if we look at, does this company pay its suppliers on time? So probably not. We see an increase in accounts payable. So, and that's, a huge increase over last year. So it's increasing faster than sales, which means that they're delaying payment, which isn't good for the company's credit rating. So if this continues, suppliers may cut off their credit or give them bad credit, which may hurt them when they look for new suppliers. So does it appear that their sales price exceeds the cost per unit, its cost per unit per sold? So no, the negative after-tax operating income and the decline in cash position shows that it's spending more on its operation than it's taking in from its gross profit. And that's a bad thing for any company. So continuing with this, go back. Okay. Sorry, I'm just trying to get the slide to fit. Okay. So if the sales manager decided after a 60-day credit term to his customers rather than 30 days. So if competitors match terms and sales remain constant, of course, accounts receivable would go up and cash would go down. So if they're offering 60 days of credit rather than 30, which could be attractive, it means that we are not collecting cash as fast, and we're burning through cash to supply the inventory that's going to be the customers are going to buy, they're going to owe us money for. So if the competitors don't match and sales double, so in the short run, fixed assets will go up to meet the increase in sales. Accounts receivable will go up, but cash will go down. So the company may have to seek additional financing. In the long term, the collections increase and the company cash position will improve if they can translate these sales and collect the accounts receivable after they kind of catch up on those 30 days. They can kind of get some of that money back. So if this company financed its expansion with a lot of external capital, and the long-term debt, reduces the financial strength and the flexibility of the company because it makes the company more have to pay higher interest rates, puts them in a riskier category, and future loans will be even higher priced. Okay, so will they require external capital if they broke even in 2018? So yes, they would still have to look for additional capital because their assets increased. Even if they broke even, if we look at the cash flow statement, we'll see that the firm made a big investment in fixed assets, so therefore they still would have to raise additional funds even with a net operating profit. So what happens if the depreciated fixed assets over 7 years rather than 10? Well, there's no effect on the physical asset, of course, but the physical assets in the balance sheet would decline quicker with a shorter depreciation period. Net income would decline because depreciation is shown as an expense, but tax payments will decline because it's reducing net income, and cash would improve because we add back the depreciation because it's a non-cash charge, so we add that to the cash flow. Okay, so we're going to stop here, and in part 2 we'll talk about the federal income tax system for both individuals and corporations.